Well, hello and welcome to Taking Stock. This is the show where we take stock of the situation all week and we'll tell you what to expect in the week to come. I'm Sonia Shenoy and with me is Anuj Singhal. Anuj, it was a week of consolidation, but by the end of the week, we did see some amount of profit taking. A routine, you think?
Routine, I think, Sonia, as you said, a step of, market going through consolidation. One step back, two step forward is the template of this market. I think one step back is something that the market could have started on Friday. The one point is that mid-caps need to correct a lot more, Sonia. I would like to see a 5% mid-cap index correction. That would take a lot of froth out of the system because it's run up 26% this year already after 12% outperformance last year. I mean, this cannot go on, whatever argument you may throw in terms of liquidity. So maybe some correction over there. And banks, the structural rally is still intact, though we might now see some tactical correction because they've also run up a lot.
Okay, let's get our first guest on board. Then joining us now to discuss the market further is Harsha Upadhyaya, the CIO Equity at Kotak Mutual Fund. Harsha, thanks so much for joining us on Taking Stock. I wanted to start by asking you about the big story of the week, which was the government notifying the banking regulation ordinance. Do you think the government has the capacity to solve the malaise in the banking sector, or are you circumspect?
No, it clearly shows the urgency and the focus that the government has in terms of resolving bad assets problem in the banking sector. But at the same time, we can't expect everything to get resolved in a very swift manner. I think it's going to take time. What is different this time around compared to some of the committees or some of the guidelines that have come out over the last 2-3 years is the fact that the first time you have RBI as one of the participants in the entire process, which means that now we need to find out the details as we go ahead. But I think it seems like RBI can direct banks to resolve some of these outstanding issues in a time-bound manner, which is definitely a welcome move. I think that is where, even if there was some hiccup because of non-consensus among JLF members or because of commercial reasons or because of the fear of possible investigations into some of the older issues, I think all of those can be set aside now, since regulator is also going to be directing the banks in terms of how to go about the entire process. So I think that's definitely a positive. But without seeing too many of the details, it's very difficult to comment how successful this will be at this point of time, but definitely a good step in the right direction, I would say. At the same time, I think we need to be worried about capital adequacy of some of the smaller public sector banks, because as you try to resolve some of these issues, the provisions will increase, the haircuts will increase. I think at this point of time, they're already undercapitalized. So to that extent, the capital will become even more scarce for some of these smaller public sector banks. So that's the worry at this point of time.
Harsha, hi. So good to have you on the show. The other point, of course, is how much of this is now in the price. You've seen PSU banks, for example, double from the recent lows. And some of the corporate-facing banks have also started to rally. Do you move some money to some of these stocks because they still remain under-owned? Or do you still stay invested with the outperforming lot or the erstwhile outperforming lot of the retail banks and well-managed banks?
We do have some positions in corporate lenders and some of the bigger PSU banks. We haven't really cut that position, so we continue to have that position. But our tilt has remained towards retail-centric private sector banks and financials. That continues. We'll wait and see how this the new step that has been taken by the government will affect the NPA side of the story. And as we go along, maybe we'll get more clarity and we'll be able to take a better call in terms of how successful this scheme will be and how it's going to impact some of the banks that we hold in the portfolio or some of those which we don't at this point of time hold in the portfolio. But our initial reaction would be some of the smaller private public sector banks will find it difficult, because once the resolution process starts, there will be provisioning, there will be high cuts, and that is where I think their capital will get eroded much faster. So we'll remain cautious on the smaller public sector banks, but other than that, the current position continues in our funds.
What is the recommendation to retail investors now, Harsha? I know as the CIO of a mutual fund, you would sort of recommend to put in money at all times. But do you reckon that at 30,000 on the Sensex, it's better to just keep your powder dry, raise your cash levels and wait for better times to invest?
While index is at the same level as what it was in the earlier peak, the earnings in the interim have gone up. They have not gone up very significantly, but still there has been some growth in earnings over the last few years. So to that extent, the valuations are not same. Even though we are at 30,000 today, the valuations are not same as what it was when it hit 30,000 first. So to that extent, one should be focusing on valuations rather than just the index levels. And also, there is no need to chase this momentum, and we have been advising the same to our retail investors as well. This is not a market where you should keep chasing your levels and keep investing at all levels. I think it's better to go on a disciplined, staggered way. Valuations have just moved above that fair range of valuations, I would say, slightly above fair range of valuations today. So to that extent, one needs to remain cautious and make those regular and disciplined investments so that the story of economic recovery over the next few years will give you wealth creation opportunities. If anybody is betting on equities for the next few months, next few quarters, I think that's not the right way to play the market.
Harsha, some of the mid-cap funds, yours included, have done remarkably well, of course, as you would expect. The index itself is up, and, I would expect good fund managers to beat index. So, what does a fund manager do now in mid-caps? Do you raise some cash levels? Do you churn your portfolio? Are there enough stocks still available in the mid-cap basket where I'm assuming with so much money still pouring in, you would have to deploy? So, what's the strategy here?
You have to be really, really stock specific in mid-caps at this point of time, and I think it's becoming a challenge by the day as markets are moving up. I would say 25-30% of the mid-cap basket today is at very, very high valuations, maybe 30 to 35 times 1 year forward kind of valuations. So that becomes a risky part of the entire mid-cap basket. And as far as our strategy is concerned, we continue to focus on bottom-up stories where we believe that the valuations are reasonable and the growth numbers are also in front of us in terms of visibility. So that is where we bet on visible growth stories which are available at reasonable valuations. And in terms of the cash levels, while it has increased a little bit in our funds, it is not very, very significant. Currently, we are holding about 6 to 7% cash in our mid-cap strategy, which is not a very high number in our opinion, but that's what we are maintaining at this point of time.
Okay. So just one final question from my end, Harsha, on what are the sectors that you would be recommending now? Because, we've seen quite a bit of sectors play out beautifully. Whether you look at the falling crude theme, aviation, tires, in the mid-cap space particularly, what would you be bullish on?
In the mid-caps, we have been looking at some of the stories from our next 2, 3, 5 year kind of horizon. We are betting currently on some of the rural stories. It could be in rural dependent consumer stocks, it could be in fertilizer, it could be in agriculture related, irrigation related. So that's the basket that we like. And the second basket that we like at this point of time is on the mid-cap capital goods side, where at this point of time, in terms of visibility, there is not much of visibility, but we believe with economic recovery gaining ground, you will start seeing some of these mid-cap capital goods companies seeing good growth in terms of both top line as well as profitability going forward. I think that is another story which investors can look at.
All right, Harsha, it was good talking to you as always. Thanks a lot for joining us and have a good weekend. That's the view from Kotak Mutual Fund. The big story, of course, this week was on banking and that NPA resolution. So let's do one thing. We'll put together a capsule of all the developments and, of course, the major reactions. Let's hear that. That, of course, was the big story of the week.
It's a very credible and a robust step. The constitution of the Joint Lenders Forum, which is going to draw its point of view from the Oversight Committee, and which is going to go into this question of the appropriateness of the haircut and the assignment of risks and obligations. That's the credible way of overcoming the moral hazard question.
Essentially say that it is a welcome step in the sense that it strengthens the hand of the lender. Otherwise, the lenders were actually moving from one place to the other, from one court to the other. So this clearly delineates a policy where the trigger is happening, and when the trigger happens, you are approaching the NCLT, and the process becomes much more faster.
In this ordinance, the bank has been given the powers to direct the banks to invoke this insolvency code. That's, I think, perhaps only help in cases where perhaps the bankers themselves are not able to take a call, or there is some not unanimity in the decision in case of a consortium or a GLF. Otherwise, the banks have already been invoking this insolvency provisions. And quite a few many cases, we have already taken action under this new act.
Markets was expecting much more than what's come around in the ordinance and what the government has done. And in fact, much more in terms of operational practical steps than changes in law and legal. Things like, for instance, putting in place some kind of a bad bank or something of that sort. We need operational mechanisms which can act quickly.
The government and RBI have made an effort to break through, I think, a major issue of moral hazard and to take practical decisions. So I think it's a very, very important legislation and a move forward. But one should not assume that, well, this is all done and dusted. That distinction one must make, because, you will have to, create a new committee. You will have to see how it operates. And the resolution does not lie in just the mere appointment of committee. There are more enabling factors that one has to look at. But a great move, I would say.
Okay, we'll take a break. When we come back, we'll discuss market technicals with Ashwini Gujral, and we are introducing a new segment this week. Every week in Taking Stock, we'll be taking some of your stock queries to Ashwini. So this week, of course, we have taken some Twitter queries. They are lined up after the break.